How a CEO tests the earning quality of his business. Your income statement reports $65 million of net income. Your cash flow statement reports only $31 million of operating cash flow. Put them together. 31 became operating cash. 34 did not. Where did the 34 million go? Keep both statements together. Net income comes from the bottom of the income statement. Operating cash flow comes from operating activities in the cash flow statement. Every equation in this lesson will point back to one of these lines. Start with operating cash flow of $61 million. This is the cash produced by the core operations after receivables, inventory, payables, and other operating balances moved. It is not the ending cash balance of $22 million. Now, net income. This is accounting profit after revenue, costs, interest, and tax. Because it uses accrual accounting, part of this profit may not have been collected in cash yet. The formula is operating cash flow is divided by net income. Take 31 from the cash flow statement and divide it by 65 from the income statement. 31 divided by 65 equals 0.48. Read 0.48 in plain language. For every $1 of reported profit, only 48 cents arrived as operating cash during this year. That is weak cash conversion and it needs an explanation. Do not memorize 7 labels. Use the checks one at a time. First, cash conversion. 31 divided by 65 equals 0.48. Second, the accrual gap. 65 minus 31 equals 34 million. Third, working capital. Receivables 38, inventory 22, prepayments 4, and lower accruals 3 make 67 of cash out. Payables provide 5 of cash in. 67 minus 5 equals 62 absorbed. Fourth, non-cash items. 20 of depreciation plus 8 of stock compensation equals fifth. Trend. The ratio falls from 1.08 to 0.48. Sixth, source of cash. Customers absorbed 38 while supplier terms provided 5. Seventh, free cash flow. 31 minus 24 of capital expenditure minus 10 of software equals negative 3. Each check answers a different question using visible statement lines. Now build a cash bridge without a calculator. Step 1. Start with 65 million of net income. Step 2. Add 20 million of depreciation and 8 million of stock compensation. 20 plus 8 equals 28. Step 3. 65 plus 28 equals 93 million before working capital. Step 4. Cash out is 38 of receivables plus 22 of inventory plus 4 of prepayments plus 3 of lower accruals. That totals 67. Payables provide 5 of cash in. 67 minus 5 equals 62 absorbed by working capital. Step 5. 93 minus 62 equals 31 million of operating cash flow. Every figure now reconciles directly to the highlighted statements. The 28 million non-cash add-back comes from 2 lines in the cash flow statement. 20 million of depreciation and amortization plus 8 million of stock compensation. These reduce accounting profit, but they did not consume cash this year. Now follow the working capital lines. Receivables absorb 38. Inventory absorbs 22. Prepayments absorb 4. Lower accrued expenses absorb 3. Payables release 5. Receivables are the largest reason. The minus 38 means the company recorded sales or balances that were not yet collected. The profit may be valid, but the customer cash is late. That is why profit can be 65 while operating cash is only 31. Inventory is the second major reason. The minus 22 means cash was used to buy or build stock that has not yet converted into customer cash. Some may support growth. Some may be slow moving. Prepayments and accrued expenses complete the smaller movements. 4 million was paid in advance. 3 million of previously accrued obligations was paid down. Together, these two lines consumed another 7 million of cash. Payables contributed 5 million of cash. This can be normal supplier credit, but if it came from paying suppliers late, it is temporary financing, not stronger customer cash. Always ask whether the payable increase is within agreed terms. Now the 34 million accrual gap is clear. It is not a mysterious disappearance. Non-cash add-backs improved the bridge by 28, but working capital reduced it by 62. The net effect is negative 34. 65 minus 34 equals 31. 1 year can be affected by timing, so check the trend. If the conversion ratio falls from 1.08 to 0.92 to 0.71, then 0.48, the problem is no longer one late collection cycle, it is a pattern. Operating cash is not the final cash answer. Point below it. The company spends 24 million on capital expenditure and 10 million on capitalized software. 31 minus 34 equals negative 3 million of free cash flow. Before judging 0.48, ask 4 easy questions. Is net income a meaningful positive number? Are both figures for the same year and business? Do the highlighted bridge lines explain the gap? And after necessary investment, is any cash left? The complete diagnosis is now simple. Cash conversion is 0.48. The accrual gap is 34 million. Receivables and inventory are the main drains, and free cash flow is negative 3 million. The business reports profit, but it is not self-funding this year. Now let us see the solutions in detail. Solution 1 points directly to receivables. Invoice faster. Give owners to the largest overdue accounts. Tighten credit limits. Solution 2 points to inventory. Separate fast, slow, and obsolete stock. Reset reorder points. Stop low-velocity purchases. Sell excess inventory. Give one person a measurable cash release target against the 22 million drain. Solution 3 points to payables. Negotiate agreed supplier terms and align payment dates with collection cycles. Use discounts only when the return is attractive. Do not create a better cash ratio by hiding overdue suppliers inside the 5 million increase. Solution 4 points to the income statement. Sales and marketing costs 55 million. General and administrative costs 50 million. Remove cash spending that cannot show a customer, margin, risk, or capability return, while protecting the capacity that produces future cash. Solution 5 points below operating cash flow. Put capital expenditure and capitalized software through investment gates. Separate maintenance from growth. Release funding by milestone and review the cash return after approval. This improves self-funding even when it does not change the operating ratio. An illustrative 90-day plan could recover 12 million from receivables, release 8 million from inventory, and gain 4 million through agreed supplier terms. Operating cash could move from 31 to 55. 55 divided by 65 equals 0.85. Better, but not finished. Remember 3 questions. How much operating cash supports each dollar of profit? Which exact statement lines explain the difference? And how much cash remains after necessary investment? The ratio starts the analysis. The 2 financial statements provide the answer.